Welcome back to the channel. I'm Foreman, and in this video I'm going to be responding to some of the negative comments that I've been getting on the channel as of late. If you haven't already seen my last video talking about Boohoo's shareholder breach, then click the card at the top right of the video. But on this video there was a lot of negative sentiment both about my strategy and also my holding in Boohoo. So I figured today that I'm going to go cover them in a video so that you can grasp my opinion a little bit better. Also, it makes for an interesting and fun video, and at the same time I'm also at some point I'm going to go back and actually respond to all of those comments in perhaps more greater detail in text, as I do try to respond to every single comment I get. And so if you haven't had a response from me, double check that comment has been posted, because I have seen a lot of comments that have been posted and then they've disappeared. I don't know if you've deleted them or if YouTube has blocked them. But anyway, the first comment to look at on the web browser, I'm going to start right at the bottom, is your portfolio and an emoji that looks like a please get some S&P 500. Now, look, I'm not jumping into the index funds because I don't think that that is a wise idea. Buying the S&P 500 whilst a majority of it, I think, what was it, the 5 largest positions or 6 largest positions in the S&P 500 made up at least 20 or maybe even 30% of the overall fund holdings. That is not something I am a fan of. Don't get me wrong, I like the big companies in the S&P 500, but I do believe that it is weighted in a way that I do not find it favourable whatsoever, and therefore I'm not going to be buying purely that. I also feel that at the moment a lot of my companies, such as the growth stocks, such as Boohoo for instance, has had a decline of over 70% the last year, perhaps a revaluation, so due to the likes of supply chain disruption, logistics, and obviously inflation from that. I think that they've now reached a fairer pricing point, but some of these stocks in the S&P 500 are still holding up very well, likely due to the amount of cash flow they have. Maybe they're in favour at the moment, and I feel that if I'm going to outperform the markets, I'm obviously not going to be buying the market, and so obviously I'm not going to be buying some S&P 500 right now, although I do believe in global diversification, and in one of my pension pots I am exposed to the FTSE All World X UK, and also I've got a HSBC Islamic fund that focuses primarily on some of those companies in the S&P 500 that also avoids the ones I don't like the Oilers, for instance. The next comment is, I have to stop watching this. I'm seeing him week by week lose money. I'm going to pause the comment there. Yes, that's true. At the moment, I've consecutively lost money each week over the last, literally over 53 weeks at this point now, where I have consecutively seen my portfolio decline or stagnate in value. But then that's not a concern for me. I'm not unnecessarily taking on risk like I did well over a year ago, which was a mistake on my behalf, and I absolutely accept that mistake. However, what I'm doing is that I'm not that bothered. I have a great risk tolerance in a way, and I'm not truly bothered about the swings in my portfolio value. Ultimately, I have a long career ahead of myself. I'm 22 years old, and presumably I could continue working for the next 40 odd years. And so therefore I believe in my own ability to be able to recover that lost capital and make it back at a much greater rate as time increases. Obviously, yes, as you get older, you have less time and therefore less compounding that may happen in your portfolio. But I feel that the value overall of earning more money and depositing more, but the true value coming from the fact that if I lose a quarter of my capital, which I'm down actually 40% at the moment, this is a very, very valuable learning lesson. And so far, I've already looked into the idea of having a margin of safety, like mentioned in The Intelligent Investor by Benjamin Graham. Effectively here, what I was doing in the past, which actually relates to Boohoo quite well, is the idea that I was buying these companies that were trading at a premium, because I felt, okay, well, premium companies can continue to trade at a premium valuation, such as a higher than average price to earnings ratio. I think Boohoo's average price to earnings ratio was something like 50 times, which is extremely premium. And what you end up realizing is that actually, once they have 1 or 2 bad trading updates, then the valuation gets cut even more. And obviously, due to inflation and supply chain disruption at the moment, obviously Boohoo's margins are even less. Their earnings are going to decrease, and therefore valued on a price to earnings basis based on their future earnings. Obviously, they're going to get stripped down in valuation, and subsequently they've fallen 72% in the last year. So in future going forward, I'm going to have a lot more due diligence in place. Obviously, I look into the fundamentals on quite a deep level. I like to look at obviously the health of the balance sheet, the past performance of the company, whether I can truly understand them and explain it very simply to a 5-year-old and they can understand it. But also the fact that I do need to look at perhaps position entry when I'm buying a stock. And I think actually this is a very underrated aspect of obviously investing. I think everyone's looking at when you should sell to bag this profit, but in reality I think if you knew when to buy a company at a specific price, then you are going to have an advantage over others in the market. My mistake, as I've said, is that yes, I did buy Boohoo on the original dip due to their ESG concerns, but I didn't take into account the fact that they already were a little bit pricey in terms of their valuation on an earnings basis, and therefore, obviously, I have been subsequent to this drawdown since then. However, I do believe over the longer term it will recover, but I'll likely get into that a little bit more. The next comment says, Boohoo, why don't you follow the teacher? Or maybe it was more like this. Boo-hoo. Why don't you follow the teaching of the art of execution? Sell while you can. You refuse to admit the situation. So The Art of Execution by Lee Freeman-Shor is one of my favourite books of all time. I have got a link in the description down below to that, and I think it is very, very valuable to a beginner investor. And I believe there are multiple teachings in The Art of Execution. You can obviously take it in your own direction or viewpoint or perspective. In my viewpoint, I feel that a quality company that I follow, one of my favourite companies that I'm invested in at the moment, not favourite because of emotional investment, but rather due to the fundamentals and the true quality of the business, that they are therefore now trading at a much fairer price to the company that they are really themselves. I've explained that last bit badly. Whereas I feel that this is a very high quality company that is trading at a much better than fair price, and therefore I feel that yes, I'm down 30-40%. Therefore, I think it's more than that, I think it's about 45%. Therefore, I should be buying more shares of the company, substantially average down my position, so that once the company does recover, providing the fundamentals do improve, which I do believe they will, and the story hasn't changed, that therefore I will be in I will have a strong position to benefit from that recovery. And I believe this is, I believe he mentions the idea here, or the comment is suggesting that perhaps I'm more of a rabbit, which is one of the topics here. But a rabbit is someone that sits on their losing position and does nothing about it. I'm not an assassin. I don't cut my losses very quickly. Instead, I'm a hunter. I lay out the money and I will put more money in as obviously the stock falls into my trap. I'm going to use that to my advantage as I will. It's been about a year since I've read The Art of Execution now, so I definitely will be diving back through it once I've read through The Intelligent Investor, because there is certainly some valid points that may have slipped past my mind. But as far as it goes, I do agree with the teaching of The Art of Execution, but I don't believe in sell while you can, because the story hasn't changed and the overall company is trading at a much better valuation, and I think they are still of a great quality. Another comment saying, I'm worried for you. Every week you lose more of your money. Please stop and go into an index fund. The next one saying, exactly, daft. Sean mentions that I'm in too deep now, and that it would be hard to sell out for such a big loss. You may wonder why, obviously, I've dived a little bit further into the comment thread, because, well, obviously, I've answered the part about my losing money, how I have a high risk tolerance, and why I don't want to invest in an index fund. But I think this is a very valid point to talk about, is that some people obviously get into into a position with a company that sinks to such a low amount that obviously they find it very emotionally difficult to sell out for a big loss. At the moment, whilst obviously I've not sold my shares of Boohoo, I have mentally written off that I'm down 5 figures. I do not care. That is gone. I have now assumed that that money is non-existent. I don't plan on selling anytime soon. I think the fundamentals of the company will improve over time, as I've said before, and I will repeating myself a lot with. I believe in the company and I have high conviction. I've already counted this as a loss of money. I'm not going to then sell out to prevent it falling further. Instead, as I said, I'm going to be earning more money to buy in. But yes, I can see how for some investors, it can be difficult to sell out of this. And I think a great way to think about it is you wouldn't pluck the flowers and water the weeds. I don't think Boohoo is a weed. Yes, they are underperforming in the last year, but it's an industry-wide concern. It's not only native to Boohoo shares, and obviously the company or the quality of the company has not changed, and therefore my perspective shouldn't either. And another one saying, in my opinion, he should have at least 50% dollar cost averaging into index funds. If I discovered investing at his age, I would literally be a millionaire now at my age and with the money I have saved. And it said, where's the fun in putting everything in an index fund? That is a very good point. I will, in a way, have a bias that means that I am less likely to buy index funds or funds on the channel, because it's a lot harder to create a YouTube channel on about, oh, I've bought the whole of the global stock market, I hold every company in the world, and then that's it. Like, what else can I really talk about other than commentary of media articles that I don't typically like to do unless it relates to some of the companies I hold anyway? So obviously that I don't believe in. But again, everyone has a different strategy. I am someone who is risk tolerant. For someone that lacks risk tolerance, is concerned about volatility of their capital, perhaps they should be looking at a different strategy where perhaps you hold more bonds. Obviously bonds are very unfavorable at the moment, but let's assume obviously the interest rates are higher. Or even for, let's say, a core and satellite strategy where 80% of your money is in funds that are low risk, and then 20% of your money is in these riskier, more speculative stocks, or what you'd consider my holdings are, perhaps, as like Boohoo and Games Workshop, where you can have a little bit more fun, but also you know that majority of your capital is protected. I think right there, he's just got a different risk tolerance than I have. We all have different investment time horizons. I plan to be invested for the rest of my life, and so obviously I'm not going to commit to a strategy that, don't get me wrong, I do think index funds are certainly a viable and admirable strategy for some, but I only believe that they are useful for those that don't have the time to pursue and really research the stock market, or for those that just don't want to. That I completely understand, and if you can't beat the market, buy it. But in my view, I'm someone that has spare time. I'm able to research the companies and keep up to date with the news. I'm able to continue reading through investing books. I'm able to continue learning. And therefore, I feel that due to that research, due to that learning, due to that return on investment on my own head, that I'm able to therefore build up this skill set of investing and do well long term. We've got quite a critical opinion on Boohoo here. They're a poor business, practically no earnings, no competitive advantage. Well, their competitive advantage is economies of scale. As they grow in total sales, obviously the industry, or the barriers to entry to the industry, become more difficult because they can undercut a lot of the other competition, and because they're able to deliver their clothing at a faster pace, at least in the UK is the only point where they're able to do this at the moment due to having their main distribution centre here. They obviously do have competitive advantages. Obviously their practically no earnings is due to short term, or medium term I would say, up to 5 years of inflation being quite high, and even obviously supply chain disruption. And if it's a poor business, it really would not have grown its revenue at an extreme level as it has in the last 5 years, so I wouldn't say that. But then you go, was able to grow so fast through acquisitions, not organic growth. Okay, right. Dodgy and inept management. Okay, right. We can say that obviously the management are dodgy. I don't know if they're inept. There's definitely has been some concerns about corporate governance, but obviously they're not inept. They're able to grow this company at an alarming rate, and they've generated significant wealth for themselves. And you've also got the CEO that used to work, or used to be the head of Primark, so that is obviously something of note. They've got, apparently, in his opinion, concerning online marketing. Again, I disagree with this, but again, that is perspective really, and who it tailors to. Prices crash for a reason, stay out of it. I don't agree with that at all. How else are you going to make money in the stock market? You can't just buy high, sell higher. Instead, you obviously want to be buying when a price is beaten up, or at least in my strategy where I like to go against the herd, and now is a good time for it. Games Workshop, a good but an extremely overvalued business. I don't think you're wrong there. I think obviously if I'd have done more in terms of looking for a margin of safety, investing more on valuation, then my position in Games Workshop wouldn't be underwater. But I do like the quality of the company, and I'm happy to continue holding. You claim to be a long-term investor, but you forget that the most important thing is to invest in good businesses that are currently undervalued. A long-term investor is someone that is invested for a greater period than 5 years. As I say, I'm invested for life. Each long-term investor has different opinions on what they think the most important thing is. Yes, I do believe in investing in good businesses, but they don't necessarily need to be undervalued, which is certainly something I've done in the past. I think actually a more important factor is investing in businesses that you can easily understand, and that you can easily vision why they're going to grow in the future. Because it's all well and good investing in good businesses that are undervalued, but they might be undervalued due to the significant complexities of the business, and therefore you won't understand when business operations aren't looking so promising. Boo is a bad business and it was overvalued, bad long-term investment. Games Workshop, a good business, but it is overvalued. Maybe it is time to learn from Buffett and Munger or reread all from Peter Lynch. Well, I have recently read One Up on Wall Street by Peter Lynch, and I've taken a lot to note, especially on obviously valuation and keeping that in mind. And that is certainly a fault I had. I did buy it obviously at an overvalued level, and I have taken this of note. But I don't think that obviously there's always more to learn, obviously. But I don't think just because I bought Boohoo the way I did, it doesn't make it a bad long-term investment, and instead, whilst I average down, I plan for it to be better over the longer term. Another comment saying he is just a stupid and stubborn investor and fooling himself as long-term investors. You should sell all of your Boohoo shares tomorrow and invest all of your £16,000 in NASDAQ ETFs instead. I think NASDAQ ETFs will be more safer to invest than Boohoo. Maybe it'll be more safer, it's a diversified fund, but the NASDAQ 100, for instance, I believe is very heavily weighted again to these technology companies, these FANG stocks. And so obviously I think there is actually a lot more risk there that might not necessarily be priced. And so obviously that changes the game quite a bit. I don't think Boohoo is of a high risk to invest in. It's volatile in share price, but I don't consider that itself risk. As I said, I don't plan on selling or trying to time when it's up or down. But I think the quality of the company with their high net cash, minimal debt, and obviously well-positioned distribution centres in the UK gives them that advantage where Boohoo is of a safer level than others in the industry. Barclays thinks Boohoo is ATP. There is competition, price rises, etc. Things I've all mentioned. Of course, competition is good. Shein is one that has been mentioned a lot and I will be talking about later. But they can outcompete the competition with faster distribution. In the UK, they are still growing their sales by 32% in the last quarter update, ending in November 30th, and that's from memory. And that obviously is due to the fact that they are able to deliver the clothing at a faster rate than the ones from China. They can compete on prices too with scale. Well, obviously Shein's going to have that advantage anyway. And price rises, well, they've got inferior goods. Yes, it is quite difficult, but they do also have premium brands. They're able to just sell more volume of these goods, and I think inferior goods are going to become actually more popular if we do walk into a recession, because their cheap clothing is going to become more desirable. People may have less disposable income, and therefore they're going to be buying perhaps more clothing from Boohoo. So again, I don't think that's a sell indicator whatsoever. I fear you're in the mindset of old. Gone are the days where people hold on to stocks for the long term, where paper certificates were the rage. I completely disagree. Investing for the long term is still a thing, and I think this is very much a cycle at the moment. I think, unfortunately, you may be falling into this cycle. Information is now readily available. Stocks can be bought and sold in seconds. True. Inflation is high. The markets look toppy. Again, I agree. Russia on the verge of war with Ukraine. Now is not the time to be a long-term investor. I completely disagree. This is exactly the time to be a long-term investor. The best time to plant a tree was 20 years ago. The second best time is now. If you're sitting on the market, outside the markets, in cash, wondering when to buy, you're going to be doing that for a very long time because you're going to be waiting for a crash that may not materialize. At the moment, growth stocks like ones I'm invested in, US growth stocks, for instance, are heavily beaten up. Ones with perhaps lower amounts of earnings but strong positive cash flow and high revenue growth, these companies are trading at very cheap multiples compared to where they were 2 years ago, and so now obviously I think is a good time to be buying. Russia is not on the verge of war with Ukraine, and you know what, quote me on this, I don't think it's going to happen. Obviously, since this comment, they have withdrawn some of their troops, but there is no evidence of this. This is very much inflated by the media to create fear. Notice how the pandemic isn't being spoken about as much now, because this is the next topic. They'll use this. This is how they get clicks, and this is how the media companies make money. I'm not going to get into that sort of thing, but I don't listen to headlines. I stick with my investments, and to be honest, Boohoo doesn't have that much exposure to that point of the market anyway. Yes, obviously it could be a concern to supply chain, which has already gone bad anyway. Why should I really worry about this, and why should I try to avoid this? I should just continue investing because we survived much worse wars before. Well, not in my lifetime, but obviously investments have in the past. It's backed up. You don't get any thanks for being loyal, you just get to watch your investment dwindle. You will get a multi-bagger, hopefully, if you pick the correct investment. over time. And if you buy and hold on, people that held Amazon through the 94% dip of the dot-com burst, they were rewarded more than 10 years later when it recovered back to its price at where it was and then grew up even further. And obviously I don't know the figures exactly, but it definitely has grown a significant amount in that time frame. Boohoo's graph looks dreadful, and for me would have been a sell a long time back. Easy in hindsight, in my opinion. It's easy to look at a losing chart and say, well, it's going to continue to lose. Put your money into stocks that are in an uptrend, and don't be that person thinking they can catch the bottom and get a quick bag. It often ends in tears. As I say, I'm a long-term investor. I'm not looking for a quick bag, and I don't know about you, but there's no tears there. In and out is the game these days. A quick 5% here is better than hoping for a 100% elsewhere. Completely disagree, but then this may be an actual trader rather than someone that has a long-term investment strategy like myself. But a quick 5% can work obviously for traders, although for a majority it does not. People just aren't that good at it naturally. But I'm not hoping for a 100%. I'm investing in companies that are growing their fundamentals at strong rates with the knowledge, knowing that eventually the fundamentals and the share price will correlate, and it will therefore reflect in the share price at what point I would be looking at a return on investment that would reflect that growth in the company, which is what I'm looking for. Sorry, Oz, I don't agree with you on this one. You're putting all of your eggs into a single basket and concentrating your risk. You don't have a crystal ball. You don't know exactly how the future is going to play out. Of course I don't. Exactly. I'm not going to try and dodge it. As I've said before, I have a lot of earnings ahead of me. I'm in a better financial position than I have ever been. Not as a flex. My net worth is lower, but I'm earning more. It's more consistent. I'm in a strong spot, providing obviously I'm not made redundant for whatever reason. But then again, I'm looking to build a portable skill set. I'm studying SEMA so that then I can have more value and attract or demand a higher salary in general. I'm in a strong spot to be able to do this. My overall net worth is low. I'm looking to build wealth long term, and at the moment I'm able to take on more concentrated risk because I'm not looking to preserve the wealth. I know that I can make this back in a limited amount of time. Yes, I do miss out on the time of compounding and obviously the time it takes to make that money, but it is not a large concern for me. Just because it is cheap, it doesn't mean it can get cheaper. You need to add back some of the boring stocks and have some firm rules about maximum position sizes. And you know what? That's a good point. Maximum position sizes are certainly something that is very important, as in the stock market, money management or risk management is very, very important. But it's not something I'm looking at the moment. I will be adding in some boring stocks or companies like Dunelm Group into my ISA portfolio once my companies like Boohoo have recovered above my average price, or where I no longer feel it's fair value to continue buying the company. And then I'm going to start building positions and diversify the portfolio a little bit more, but I'm still only going to be holding a handful of stocks, meaning less than 5. Respectfully, Boohoo is not a good company. They have not recovered from the bad reputation of immoral wages. They have the most terrible quality ever that I doubt they will increase in popularity since their peak. I completely disagree. I'm wearing all Boohoo clothing. My jeans here, for instance, I think these are good quality. They fit very well. The socks are very comfortable, and I like the shirt. It's very smart in my opinion. Yes, the fabric is a little bit cheap, but it's fast fashion. What do you expect? And as far as I'm aware, I'm someone that always used to wear Primark, and actually I used to wear a lot of Top Man as well. This is far better than Top Man, not Top Man, Primark, and Top Man were just way too expensive for a marginally better quality good. Let's have a look. I don't think they'll increase in popularity since their peak. Well, their total sales in last quarter grew by 32%, and this is for the 3 months and the 9-month period of this financial year. So I do think they are growing, and it's just the UK that obviously it's growing. Obviously the rest of the world isn't growing, but that's due to supply chain disruption and extended delivery times and greater amounts of returns. And I think during the pandemic we had seen a lower amount of returns, but now obviously we're seeing a lot more returns, and I think it's becoming back to the normal. So yes, they have got rising returns rates on their dresses, for instance. I think this is how shopping will become more of the norm, because again, when it was during the pandemic, people were mainly buying clothing that was more comfortable, loungewear. They weren't as concerned maybe about the fit as long as it was comfortable, so it was less reason to send it back. You need to cut some losses and actually diversify into more than 2 stocks. I don't need to. I'm not cutting my losses, but I'm not being inactive on the position. I'm significantly lowering my average price, which has dropped from £2.47 per share in Boohoo, and that was at July, I think that was like August 2020. It might have been August 2020 actually, when that had dropped. And obviously now it's £1.74, I believe. Like, I am really pushing this average price down. I'm not sitting inactive, but I have no need to cut my losses because the story hasn't changed. It's industry-wide factors. Your strategy is straight out of Nick Sleep's front pocket. If you don't know who Nick Sleep is, I highly suggest that you Google him. Nick Sleep, and I can't say his first name, but Zakaria or Zach, they ran a fund called the Nomad Investment Fund or something like that, and they did very well. They ended up closing the fund and only holding 3 stocks, which were Amazon, Costco, and Berkshire Hathaway. One of note, and they are very skilled UK investors that certainly stayed away from the public eye for the most part. I'm glad you're confident in your ability, but may I suggest to you, all investors, no matter at what time in life, we have something to learn. Completely agree. I do not feel that in any way that I have all of this knowledge and that there's always more to learn. That's why I'm very keen in reading more books where I can and really seeing the counter argument. If someone came up to me that was well studied in Boohoo or even in Games Workshop and they said, look, actually, I don't think Games Workshop is a good investment. Here's why. Their inventory is building up. Their volume is lower, but the only reason their earnings are the same is due to the fact that they had a higher amount of royalties. This isn't a good trend for the long term of the company, and this we're talking about Games Workshop. And I'd be like, okay, you know what, that's a very fair opinion, but this might mean, but we are seeing obviously royalties rise, and that royalties rising are a good indicator of their intellectual property having significant value. I nearly just counter-argued myself out of the point there. That was quite amusing. Anyway. In case of your purchase of Boohoo, for example, not long ago were you buying them at a considerably higher price than now? Completely agree. Did you act as best as you could? Could you learn from your experience, or is there nothing to learn? If an investor replies, the later the standard and often false excuse is it's the market's fault. Oh, Mr. Market, why are you doing this to me? No, I understand that one as well. I didn't do the best I could. As I said before, I didn't invest purely on valuation. I saw they were trading at a premium, assumed it could continue for the longer term. Obviously, I know that now, and that is one of the key lessons I've learned from Boohoo, and not one that I plan to repeat anytime soon. And I will be taking more metrics into valuation, such as net cash, enterprise value, which is what they could be bought at market price, dependent on the market capitalization. And obviously things like price to assets, price to book. Again, that is price to assets and market cap. Again, this is something I'm very much looking forward to, and DCF, discounted cash flow model, in the future. I believe there is learning to be had from all experiences, but to obtain learning first and foremost, an individual needs to be open to it. As I say, I completely agree. Hope the play on Boohoo works out, and good luck. Much appreciated, as always. After almost a year of telling you to use dollar cost average using limit buys, you finally saw the benefit. Well, I mean, I've been dollar cost averaging since I started the portfolio on April 6th, 2020. I was paid a weekly salary at that point, or a weekly income, where I was being paid every week, so I deposited money into the markets every single week. I am now on a monthly salary. I deposit every month, but I also trim that into amounts I can invest each week, which if there's 4 weeks in a pay period, it means I'm going to invest £250 each week. But limit buys are only really that good in high volatility moments. If obviously Boohoo, in hindsight, I'd have realised, yeah, actually, it's downtrending. Sorry, excuse me, I've got a bit of trapped air. If I had realised, yes, it's downtrending, and okay, I could look at the chart now and say it is, then I could put some limit buys down and say, hey, look, if it drops to £1.10, it'll buy 100 shares. If it drops to £1.05, it'll buy 110 shares. Yes, I like that, but at the same time, I'm not going to be sitting out of the markets for too long, and at the moment, I'm more interested in building my position and lowering my average. So long as my average is below, so long as the market price is below my average, the story doesn't change, then there is little to no benefit of using limit buys. I may as well just continue buying at the frequent basis that I do, and that is more advantageous than obviously trying to find trigger buy points and being a little bit too greedy. You've used up most of your cash according to the pie chart, which is my Patreon, by the way, link in the description down below if you want to see my live holdings updates, and you should sell at 30% loss when you should have. Again, I think maybe I should have more, and I did actually. When Boohoo dropped by 20%, I reviewed the position. I looked at it as if it was the first time I'd ever seen this company, and I judged for myself whether it was worth to continue holding. At that point in time, I found that it was, and so I did, and that's why I didn't sell at loss, and instead I carried on buying down and lowering my average price. Doesn't Boohoo's competition from Shein and Primark worry you? You just have to look at Boohoo's 5-year Google Trends chart to see it decline in search volume. In contrast, Shein's 5 years Google Trends chart is increasing. I'll counter that. Boohoo is a holding group for many different brands. You need to be looking at Debenhams, you need to be looking at Pretty Little Thing, you need to be looking at Nasty Girl, you need to be looking at Dorothy Perkins, all of these things, and you need to look at the Google Trends charts for that. Again, that's a very, very narrow thing. Boohoo mainly operates, I believe, in terms of using Facebook ads, so social media promotion, rather than, for instance, using Google search. Again, it's a very narrow view, but again, yes, Shein is competition. Shein can be a concern. I've mentioned this before on my Twitter. But unless they're able to deliver faster than Boohoo, they're not going to maintain a competitive advantage in the UK. The UK, they have the operational advantage where they're able to keep ahead of the competition by using their test and repeat business model, in which they're able to supply a small amount of products to the market. If the market says, hey, that's good, then they can produce a shared load more, and they're going to do that at a faster pace than shipping from China that takes 2 to 3 weeks. Unless obviously Shein start building massive distribution centers in the UK and creating their products in the UK, which is going to sacrifice their margins anyway and their quality. I don't know how that will change. They're not a concern for Boohoo in the UK. But in the US, of course, they are a big concern, and the rest of the world. So Boohoo does need to get distribution centers set up. They're doing it in the US. They definitely need to settle down and put some money or more money into it and get it fast-tracked to make sure the quality is good, because obviously that is a concern. As for Primark, they're not concerned. They are good competition and certainly a very good benchmark. I like Primark, and I think that both the companies can operate, one being a high street only retailer and Boohoo being pretty much an exclusive online retailer with the exception of their one Debenhams store in Manchester. Nice to see the conviction you have in Boohoo. I'm a speculator, so I obsess on companies' cash runway. I assume you've checked this already, but the runway of Boohoo, if your chief concern, can they outlast an inflationary period? In my opinion, yes, £98 million of net cash and obviously a lot of total sales. They're going to have positive free cash flow, but obviously at the moment this is negative due to their acquisitions, high amount of acquisitions of the brands from Arcadia. So at the moment, obviously it does look quite poor. As they will struggle due to low margins within their industry. Again, they have higher margins than others in their industry, not gross margins, but I believe, is it net margins that are higher? Again, okay, now this is pushing a little bit into my accounting skills, and I may be a little bit off here based on financial statements, but their gross margins are typically lower, but due to the nature of their business model being vertically integrated as a whole, they're able to make greater overall profits compared to other competitors like ASOS. Will they need to raise capital? Unlikely, but I wouldn't be against it. But at the current price, it wouldn't be a very good idea for Boohoo. So I don't think it will happen. And obviously, with a shareholder or an insider of Mahmoud Kamani being obviously the founder or the co-founder, he's got a stake of something like 20% of the company. I don't think he'd want to do that either. Any large debts due to be paid soon? None at all. They've got a £50 million loan facility, which is long-term debt as far as I'm aware. But naturally, they will struggle to refinance with inflation, or at least have to pay exorbitant rates on a reduced capital sum. Agreed, they've got £98 million of net cash. They will be fine. Fast fashion is coming under scrutiny. Our generation is very eco-conscious. I would keep counsel to keep a close eye on industry trends. No doubt you've already familiarised yourself with ESG statements. Large fashion brands won't just die, they will change their approach. I agree with that. Boohoo are obviously improving their ESG, but they're not eco-conscious. Fast fashion is coming under scrutiny, but again, the ones that are giving it scrutiny are the ones that can afford to buy more premium goods. At the end of the day, if you're struggling paycheck to paycheck, you've only just got enough to put food on the table, you're not going to be worrying about, is it eco-friendly? You're going to be worrying about, have I got clothes that I can wear and that the kids can wear? So realistically, that is a first world problem right there. But you are likely to be correct in your assumption. Once inflation is brought under control, fast fashion will still be here, providing Boohoo retain popularity. They will benefit. Best of luck, sir. I like what you're doing. And I mentioned before, towards your attitude towards the transparency and investment is great and is exactly what is needed for success. Much appreciated, Ben. And then to be fair, there were a few people that were like, actually, there's a lot of negative comments here, and they gave some very good opinions. And obviously, I'm not going to be giving these people the time because, again, I'm not reacting to those comments, but I do appreciate the support that they have. It does interest me that some of these comments that get quite a lot of likes in my comment section are ones that are very short-term narrative, and the ones that are truly being supportive, such as saying, let's go on about how the sentiment is negative, only have very minimal likes. Indeed, but again, fear sells, so that's how it would roll. This comment mentions, I do think you need to suffer losses when investing at first. It teaches you that DCF models are a way of making assumptions, sound like concrete facts, and wrongly reassure yourself in broad brush terms without looking at reality and durability of growth of earnings. In the 2000 bubble, my workmates had endless DCF growth spreadsheets attached to darlings of the day. Didn't stop the 9% crash as it all crumbled like Boohoo. Once you've been burnt and scarred, you know that you cannot have such concentrated positions. And this is all about perhaps risk management, saying keep your position sizes in check. But then again, I'm not doing very, very optimistic DCF models. Again, when have you seen me do a discounted cash flow model on the channel about any of the companies? I think I've mentioned it once, twice. Obviously, I mentioned it earlier in the video, and it's part of due diligence. But then I estimate that a very, very low, I have very conservative estimations. There's no point giving optimistic estimations because, quite frankly, I'd rather expect the worst and hope for the best. If you expect sales to be very, very bad, you'll buy at a much cheaper price, and over the longer term, it might pleasantly surprise you. That's how I roll, but I do agree with this, and I think it is very important. But the moat being very tiny and insane growth valuation being on an online pandemic, coupled with massive money printing from the central banks, again, you can't avoid the money printing, you can't avoid being an online pandemic, but yes, the growth valuation was high, but the moat isn't tiny. This is a durable company. They've got nearly £2 billion in total sales for this year, depending on the last quarter. I don't think there's really a concern there at all. Again, their moat will be built over time through their economy of scale, their shared economy of scale, as they're able to produce or output more goods. They're able to buy in bulk at a cheaper price and therefore deliver the cost reductions to the customer, therefore increasing their volume, which therefore improves the business quality. Again, shared economies of scale is one thing to 100% look into. Hi Osborne, it's great to see your passion for investing, but please don't fall into the same traps as most new investors with regards to overconfidence, justifying losses by saying they're in for the long term, averaging down, and being obsessed with one or two companies, resulting in a highly concentrated portfolio. FOMO on any potential rebound as it is too large. Okay. Overconfidence. That is a very, very, very good point to mention, because when I make these videos, when I talk about all of this, I do have confidence because I have conviction. I've done the research. I'm not here to, what is it called? Is it narrative fallacy framing bias? I'm not changing my story based on the story of the company. So, oh no, Boohoo's gotten slightly worse. That's fine. It's still bullish. This is why. I'm sticking with the same steadfast opinion that I've had. Boohoo, yes, their margins are going to be razor thin. In the short to medium term, inflation is going to be rife. Boohoo are going to struggle. But I'm confident because I've done the research on the business. I've read the 6-month presentation. Have you? I've read the last trading update in its entirety, again with the 6-month presentation. I've read one of the annual reports. I want to read more. I've just not had the time at the moment. It's one of those things. The more reading you do, the more you know, the more confidence you can have. Again, no, I'm not talking about short term. Boohoo's share price, I would never have expected to have gone down 70% the last year, because in the short term, I don't know what's going to happen. But I believe strongly over a 5 to 10 year period that share price will be considerably higher than it is now based on the growth of their fundamentals. And if they're able to grow their fundamentals or their revenue by at least 15% each year, then we will be looking at a much, much higher share price. Justifying losses by saying they're in for the long term. You can say that. Yeah, you could say that I'm justifying my losses by saying I'm in for the longer term, and that I'm averaging down purely because it's a big number. And I don't think there's much I can really do to counter that. I think that's a very valid point. I can only know myself that I'm not doing that. I know that what I'm invested for, I know I'm invested for the quality of the company to improve or their fundamentals to grow over time. I'm not investing on a share price purely, and so obviously it changes the game a bit. Becoming obsessed with one or two companies, resulting in a highly concentrated portfolio, again, I think that's a good thing. If you are very niche in what you are skilled in, I like retail, I work in hospitality, or I work in for a company in the hospitality sector, which is very similar to retail in my opinion. I therefore can have, or there's definitely an overlap. Let's say we had two, like a Venn diagram, there's definitely an overlap there where I'm able to use my skill set in a more portable manner to research retail stocks. Yes, don't get me wrong, I'd have a better advantage investing in hospitality, but I don't like the business models that they have, and so obviously I've pivoted slightly into another consumer-facing business, and that's my advantage. That's why I'm highly concentrated, and obviously I have a higher risk tolerance, as I mentioned countless times before in this video, hence why I have the concentration. Fear of missing out on any potential rebound as position is too large, etc. I have no fear of missing out. I did in the past with Argo blockchain. With this one, I'm patient. I'm happy for the shares to remain stagnant for years because I will keep accumulating over time. It depends on the fundamentals growing over time, and their guidance for Boohoo is 20 to 25% net sales growth, or it might just be revenue growth each year on average. That is promising if they're able to reach their guidance, which I think is a little bit optimistic for the next few years as inflation is rife, as I've mentioned. I think it's going to be a little bit lower than that, but over the longer term, if they're able to nail that, then yes, I think that is very promising indeed. I'd recommend you read the ODX bulletin boards. I don't read any chat boards for any investment anymore. I used to briefly look at the Boohoo share chat boards, but I realised it's the same old rubbish. People going, oh, Boohoo stock's now going to hit 110 pence per share. I'm calling it's going to happen tomorrow. Oh no, Boohoo's going to drop to 80 pence per share. It's a load of rubbish, honestly. It gives me no value. The only value I've ever gotten from the chat boards is by finding niche articles or perhaps short reports like the Boatman Capital report on Argo blockchain or the Shadowfall report on Boohoo. I was able to see that fairly quickly, whereas I didn't read it for a news article, for instance. But again, I don't follow that stuff because it's full of rampers and derampers. I have no interest in the public opinion of a company. I do not follow the herd. But again, I see the value in this comment, where it does say, yeah, I recommend you read these bulletin boards. This is a company that has gone up. It was overhyped during the pandemic because it had some, I don't even know, to be honest. I didn't really look at it very much. In fact, I only looked at it after it had gone badly. I think they were like £5 or 5 pence per share. They went up to like 37 pence per share. It might be pounds, don't know. And then obviously it dropped back down to where it was. People bet their life savings on it. It was quite a sad story on Twitter about it because they had invested their savings expecting it to go up. And obviously it didn't because they fell for the hype. This is something to keep an eye on, but again, Boohoo, why would they drop another 75 to 90%? This is a whole different story to ODX, and I think ODX was a company with a market cap of less than £20 million. This is a company that was worth £4 billion a year ago and is now worth about £1.2 billion. So there's a significant difference in size there and really strength of the business as a whole. But I guess, yeah, don't underestimate how bad things can get, but things are always darkest before it gets light. So, obviously, we may be in the darkest period of time. It may get darker. But you need to know that there is light at the end of the tunnel, providing the story of the company doesn't change. Start diversifying. There are thousands of good companies out there. Disagree. Diversification is protection against ignorance. This is valuable for those that, as I mentioned before, are wanting to defend their capital against systematic risk. There is advantages and disadvantages to diversification. In a general rule, I do agree with it, but as for someone like myself, I don't believe in it for me. However, there are not thousands of good companies out there unless you're talking about the global stock market. Realistically, good companies, or great companies really, are difficult to find, and that you shouldn't be looking to buy every single good company you can find because ultimately, and I will leave it on this comment here, you can only invest, if you invested in your 50 best ideas, they're likely not going to do that well. Whereas if you invest in your 3 best ideas, they're likely going to do a lot better. And that was actually mentioned in the Art of Execution, Lee Freeman-Shor, going back to that video there. I hope you enjoyed this video. I wanted to respond to these comments because it's going to take me a very long time to respond to all of these. And I figure it gains. It's a very easy topic to cover, very easy video. I don't need much preparation, and it's very much with the flow. So if you like this video, please drop one of these to help support the YouTube channel. And if you'd like to see how to make £1,000 a month in dividend income, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.